Not only does India Inc. have to implement new accounting standards, it also has to contend with new tax accounting standards. While do the both speak the same language, or will money, serious amounts of it, be lost in translation? Hello and welcome to Mind the Gap. Today we focus on the 10 new tax accounting standards that are effective this year. And to discuss the implications, I am joined by S Gayathri, the head of taxation at the Essar Group, Vineet Agarwal, the head of taxation at JSW Steel, and Vishal Shah, tax partner at PwC. To all three of you, a warm welcome. Vineet, let me start first with trying to understand the need for these 10 new tax accounting standards. If I get it right, they're essentially to prepare us for the move to Indian accounting standards?
They wanted to prepare the tax base for new IFRS. Okay, and second thing was how to harmonize the existing accounting standards. Now there was an earlier committee in 2004 which has already stated that what's the need for accounting standard, tax accounting standards now, when there are already 27 or 28 accounting standards adopted by ICAI and Ministry of Corporate Affairs, which are already have been adopted. They can be very well adopted, and whatever harmonization is required, you can do it in Act itself. Now what has been done? Finally, these tax accounting standards are doing nothing except undoing the old court cases which have been settled. This could have been done by amendment of Act, and ultimately it has been done by that only.
So you're saying that there is no purpose to be served by these tax accounting standards? Aren't they supposed to help you prepare for IFRS or Indian accounting standards in that sense?
No, they are
Bridge the gaps?
No, I am afraid they are not doing that. In fact, the Tax Accounting Standard Committee itself has stated that we are not answering the mandate number 2, that is convergence towards IFRS. They have limited themselves to harmonization of existing accounting standards. In the manner they have done it, I wonder they are actually conflicting that.
See, the way I look at it is, any new code, law, standards are welcome, so long as they serve the objective of simplicity or facilitating compliance in a better manner or implementation more easily by the regulators, regardless of their stated objective. The question is, what do we have here? We have another layer in the process of a taxpayer reporting and paying tax on his income. So while earlier you said, okay, here's my book profit as per the accounting standards, and then computed as under the Act, you compared it with profit as per your Income Tax Act, and then you paid MAT to the regular tax. What we have today is the same accounting standards, the book profit, and then a computation based on the ICDS. But it doesn't stop there. You can't. You have to continue making further adjustments depending on what the Act actually says. So what we have effectively is an additional layer which involves, although there's no mandatory requirement to maintain separate books of account, the point is you can't give effect to all of those standards without really maintaining a separate set.
Vishal, if they don't meet the objective, as Vineet has pointed out, of preparing us for IFRS or Indian accounting standards, if they require you to maintain a second set of books and therefore are really not simplifying your compliance process or taking away the grey areas, then what do these 10 new tax accounting standards do?
You would ideally want your corporate tax, and in the Indian context a very important thing, which is regulations, to all sort of converge for making the business eased out in India. From a foreign investor perspective, today you have a set of FMR regulations which in some cases says preference shares as equity, in some cases it says preference shares as debt. Similarly, when you come to tax now and the accounting, your accounts might say that preference shares is again debt, but your tax will say that the dividends on preference shares are actually dividends and not interest. So you're not synchronizing the two laws there. Is that something which is creating confusion, and is that going to help your ease of doing
business?
That's
what these 10 standards were meant to do. Are they achieving that objective? That really is, the core of what we want to discuss here.
Not all of them.
Okay.
They are trying to achieve some level of standardization. For example, in how do you get forex accounting for tax purposes done? How do you get borrowing cost accounting for tax purposes done? But is that something which is done in the correct manner? Because if you wanted to do as both Vineet and Gayathri have said, you could have just amended the law rather than adding 100 odd pages to the legislation, which is creating more subjectivity. So while your intention was to reduce litigation in the first place by trying to make it simplified, you are now adding about 100 pages, a lot of new concepts, reasonable certainty, and so on and so forth, which were never existed, never interpreted by anybody in this country, and now you have to deal with all of them. Probably only the accountants and the finance people are in business.
Okay, so we've established in the first few minutes that there is really no place for these tax accounting standards. At least that's what all three of you tell me, and that while they attempted to answer questions, they have actually raised more questions themselves. We'll try and focus on some of the more important ones on that list of questions. I want to start first with talking about the area of revenue recognition and where these tax accounting standards fall short. Principally, the problem I'm told here is that they do not recognize prudence or materiality, and that's really where the big area of shortcoming is, and thereafter that flows into specific situations and impact specific businesses and industries, which are.
Yeah. So let's look at a construction sector, for example. In the construction sector, you have projects which run for a longer period of time. There is obviously uncertainty as to whether you will be able to make a profit or a loss on that situation or not. Therefore, the accounting standard, both the current GAAP as well as the Ind AS provides that if you in a year 1 itself foresee loss that you may have to incur in year 3, you really need to provide for that loss. And what the courts had said from a tax perspective is that when you provide for that loss, you're really determining your real income, because if there is a loss going to arise, you're not going to be required to pay tax because there is no income to pay that tax on. What you're doing by eliminating prudence as a basic principle and the impact on construction contracts. The standard, the ICDS rather says that you will not take the full anticipated loss. You will only provide for it to the extent of percentage that you have completed the project today. So instead of providing 100, if you have done only 30% of the project today, you will only provide 30% of the anticipated loss, which means that you are preponing a part of the income and postponing the loss. Now, two impact there. First, India only has loss carry forward provisions, right? So if you book a loss in year 1, you can set off against income that arises in year 2.
Right.
You don't have loss carry back provisions which exist in countries like the UK and the US, that if you have income booked in year 1 and you can take and loss coming in year 2, you can take that loss set off there. Prudence would have been in line with what you have today, which is carry forward provisions, and therefore should have been ideally continued. Look at the second way. You're probably going to arise instances where there is double taxation. Let's take an example. When you have a construction company, in the books today, it will provide for the full anticipated loss. So therefore, you might have a loss situation in the books today, but the tax will not recognize the full loss, and therefore you might have income for tax purposes. So in year 1, you will pay tax on the normal income. Come year 2, that loss will not be there in the books, but that loss will be there for tax purposes, which means in year 2 on the same project, you are again paying MAT income, because that will go only by book profits, will not adjust these situations.
You just end up paying more tax in all of these
circumstances. It would lead to double taxation ultimately.
Yeah, there are so many other instances. I mean, basically, thanks to the government, basically that at least this reasonable certainty concept has come. If you see the original task, proposed task, it was not there.
That's from 2012.
Yeah. Now, what will be this reasonable certainty? Only assessing officer will know. Neither the assessee nor the accountant can decide on that. So that kind of concept you have already brought in. You are supposed to take out the discretion. It has been brought in.
So some part of the problem has been solved
because of industry
representation.
But the double taxation still remains.
Right.
That because this income has been taxed now, in the next year when I have not booked that as in my income, my books, but when I book that income in 3 or 4 years down the line, when the income has actually accrued or actually virtual certainty has arisen, I pay on MAT.
Is that what you're anticipating, that you will have to eventually pay more taxes?
Yes, definitely. I mean, to take another example in the construction business itself, you have this concept of retention money, which you ordinarily wouldn't book because there is no real income that is accrued. But today what you have to do is apply the percentage of
retention money is what? The deposit that people put? What is the retention money?
Yeah, you retain it till everything, you've performed your obligations, and only after that can you recognize that.
Right.
And that's how the accounting standards have, laid out the principles. But here you have to start recognizing it. And really what happens is, with all of these differences, between the standards and accounting, normally you would believe that they would go into the deferred tax zone and therefore be recorded in the books. The point is, even for recognizing a deferred asset, you need to have virtual certainty. It's not as if you can just go around booking anything you believe. There are some requirements to that. So if you don't fall into that, it doesn't appear to be a virtual certainty, but because of ICDS, you have to declare it as income, you are really left in a bad spot, because this is going to affect your financials, your lenders, your potential investors, and anyway.
Okay, I've mostly heard construction examples, but does this cut across many more industries? Please.
I'll bring you to power in the regulatory framework.
Sure.
And what happens every time you have to go to the regulators, the regulatory agencies that to fix the power tariff. Okay. Now you make a claim, but they give you interim rate, and you have to book revenue accordingly. Now, since you have given a stated claim which is as per you is correct, so now there is a reasonable certainty that these claims are to be made. You are virtually reasonably certain that this claim is going to be there, and for the assessing officer this is sufficient. But actually, by past practice, these amounts are never going to come, because regulator never approves what you claim. And now, second aspect, when you go to write off whatever has been earned as income outside the books as per these standards. In the write-off, earlier the write-off provisions, after time memorial, this issue has been settled, that whatever assessee considers that it is irrecoverable and actually written off the books, there is nobody to challenge that. Supreme Court has time and again told that now there is no discretion to challenge the wisdom of the appellant assessee. That once he has actually written off the books, the matter is over. You have to allow it as write-off. Now once again, because of these incomes, once again the concept of irrecoverability has come. So now once again it will be a battle zone, how to prove that certain income which was never my income earlier has become irrecoverable, because certain income which I've never considered as income, how will I prove that it has become irrecoverable?
Is it just construction, power? Does this cut across lots more industries? What happens if the current revenue recognition standard under Indian accounting standards gets deferred, and we stick on with the Indian GAAP revenue recognition standard even next year when the rest of Indian accounting standards are implemented? Will there continue to be so much dissonance, or will it narrow?
Yeah. So two parts there. One is when you have sale of goods in a manufacturing setup, etc., and the other is the services sector. Let me take briefly both of them.
So all of those get impacted.
There. Sale of goods. Today the ICDS principles are more or less aligned with the current IGAP or the Indian accounting standards principles. Come Ind AS, when the whole move will be going towards control and possession as the basic objectives under which you recognize revenue, you will certainly have dissidence between what the current ICDS will say, which is more like the IGAP,
and what the
Indian AS will say. Let me give you a small example. As a manufacturing organization, if you dispatch your goods on 30th of March of a particular financial year, today you recognize that revenue because you would say the risk and rewards have been passed on to the buyer. Next year, when it comes to Ind AS and you need to recognize that, you need to not look at only risk and rewards. You also need to see whether the control and possession has been passed on to the buyer. Now they will take 3 days in dispatch, so let's say they will reach the buyer only on 2nd April. So for Ind AS, you may not be required to recognize that revenue, or you will not be able to recognize that revenue under the Ind AS principles. But when you come back to ICDS, you will see that this has, under the current IGAP, the rules are similar there. You might have to recognize revenue on 29th of March.
You had recognized the income in March.
Exactly.
But you actually recognize the income in your books only in April.
That's the sale of goods. Now let's go look at services. Currently, services sector, your institute accounting standard allows you to follow either percentage completion or completed contract method. Most people, like even accountants, for example, investment bankers, etc., all the financial services industry players will have impact into this, because today you recognize your revenue based on mostly completed contract of methods. And in some cases, it will be very difficult to even recognize revenue on percentage completion. Let's say you're working on a transaction which has a success fee model. You might have completed 70, 80, 90, 95% of the work. You will never know whether the revenue is ultimately going to come or not. How would you apply percentage completion there? Come in AS, it also requires you to do percentage completion on all the cases. Unlike the sale of goods, the services part of Ind AS is not likely to get deferred. So you might potentially start having these issues in the accounting as well next year, which will then mirror
So where is the difference
ICDS.
with tax?
Gap is in the services sector is currently, when you're comparing ICDS with IGAP, that gap will probably get closed up when you move to Ind AS, because services under the Ind AS will only need to follow percentage completion, and the tax will also say percentage completion. So you will move away from the gap in services.
It will match next year.
For services. On the other hand, for goods, what is matching today, you may not match it next year.
As we draw up the list of areas of clarification, let me go to the next point. I know you raised government grants. In my conversation, I've come across three other areas besides revenue recognition: government grants, foreign exchange, and borrowing costs, right? What would you rate as you know, some of the more challenging areas?
One is government grant.
Right.
It has been always a debated issue, settled by courts. In fact, it was part of DTC also. The government wanted it to be taxed as revenue income, except that 43 amendment it was brought earlier. They could have done it by amendment, and they have done by amendment. I don't see why it was brought in this accounting standards at all.
Okay.
Coming to foreign exchange, yeah, there's a ray of hope there, because there were a lot of disputes, lot of Supreme Court decision, everything were to be followed. I think it has brought some certainty as far as monetary and non-monetary items are
So
concerned.
explain that to me with an illustration if you can, saying
see,
what changes now
yeah.
because of the application
Now,
of this tax
like
accounting
monetary
standard.
and non-monetary items,
Right.
where you had to account for at the year end for at the prevailing exchange rate, there was always a dispute whether that loan has been, or that, let's say a particular borrowing, whether the loan has been used for working capital or whether the loan has been used for a fixed asset.
Right.
There was always a debate, and assessing officers used to disallow the entire. If there is a gain, they will always tax it. If there is a loss, they will always disallow it. Matter went in Woodward, I think this Woodward decision, where the Supreme Court itself blasted that you can't take two, I think there is a hero decision also in that you can't take two standards. When it's an income, you tax it. When there's a loss, you can disallow it. And they finally said if it's a utilization is for capital assets, you capitalize it. Revenue income, you allow it.
Yeah.
I think that has been clarified here. And that could not have been brought by way of amendment in the Act. To that extent, it could have been come by way
That
by
is
way
the
of.
only standard.
That's the only thing which I say I'm happy with.
That is the only
that.
standard. I
Yeah.
think that's standard number 6 if
Yeah.
I understand correctly,
Yeah.
right?
So
that is the only standard
yeah.
you're happy with.
So
of
monetary
the
and non-monetary, where they brought it. Now coming
Okay.
to borrowing cost.
Ah.
Now this is a series of history on that. Section 36(1)(3) has been amended time and again. Government
No,
loses.
but before you dive so deep into
Yeah.
it, can one of you explain to me what the changed position on borrowing costs is as a result of this tax accounting standard?
Yeah, now you are capitalizing even the current, even the inventory and interest towards inventory, interest towards assets which are being used in the business, not in the current business, not even the extension of business or new business. See, there was a position earlier where every interest, if it is borrowing, it's for the purpose of business, is to be allowed. Then the famous Tata Chemical case came, where then the amendment came, and then that borrowings for expansion of business to be capitalized. Only interest component for expansion was to be capitalized. Now you have brought in the third aspect. First you brought this accounting standard, then surreptitiously you amended the Act on 30th of April when Parliament, it was introduced in 20 minutes and amended. Nobody even was given chance to see what has happened. In fact, there was industry hue and cry that this accounting standard is contrary to what the Act is. So you change that without even discussion. Now what you have done, even my working capital borrowing, interest has to be attributed to each and every asset. So if I go minutely, even I buy a typewriter, and for a day the typewriter is bought, I pay the amount to the buyer, to the seller, and the typewriter is delivered to the next day in my office. But one day, whatever interest, nominal interest is there, it has to be capitalized towards the typewriter. Even if it's used for my existing business.
If we're looking at a corporate on a long-term basis, yeah, as I said earlier, all of these are mere timing differences. You know, it's minor adjustments here and there will always be timing. Within if you capitalize, you get depreciation. The question really is, you know, for the small change or the timing in terms of when you pay the tax, you need to do so much of different calculations outside of your books, and therefore you'll probably have Excel sheets which will run for years, because you'll now, if you capitalize it until the time, let's say the particular asset is used for 30 years, you need to keep a reconciliation of what have you capitalized and what have you debited in the books and so on and so forth. It just creates that much more difficulty in terms of compliances. And even if you want to be an honest and a fair tax-paying citizen, it's a difficult task at the end of the day. You know.
But these are areas possibly that
Revenue recognition and this borrowing cost, these are the two aspects which will actually compel us to maintain a separate
Which is exactly what you pointed out right at the beginning. Those who are watching this show will want to know how y'all are working around this, if I may put it so, or preparing for this. So what would you say? I mean, in any of these three, or for each one of them, whether it's borrowing costs, foreign exchange, at least you think is a good place to be in. So we'll leave that out in that. Yeah, but or even on the issue of government grants, right? what should companies prepare for next year, which is the assessment year?
No, you can't do anything. There's another item which has been become taxable.
Actually, it's a conceptual shift. Like, you spoke about a typewriter. What happens is, earlier in the standards, they look at an asset as something that needs to be developed over a period of time. Obviously, what is not factored in is these, over the counter what you buy across, say a laptop or an air conditioner or whatever. And today, within that formula, there are so many other little aspects. Like, you talk about only the average of the assets overall and the specified assets on the first and the last year. All of these things, lead to small little ramifications that possibly would really come out only when you start working on those Excel sheets. Or if there's an asset which was there, if it is not there at the end of the year, then you take an average of, half or 50% value or something like that. Never mind that might have been due one month, or one day. So these are the small little ones, but I'm really confident that the CBDT will come out with clarifications on some of these.
What should companies be looking out for?
Give you two examples. Today you are doing some contract manufacturing from a small time player. You're getting your goods manufactured by them. Today you show that as purchase and sale, and that's very easy treatment given purchase of goods, sale of goods on both the sides. Come next year when you go to Ind AS, if that contractor is sort of almost wholly dependent on you, let's say you only manufacture 90%, 95% of the goods only for you, you might be hit with a situation where you may have to start recording the entire arrangement not as a purchase sale, but as a finance lease transaction. So you will actually capitalize his assets, his plant and equipment into your books, and then give him something what is known as tooling charges or subcontractor charges. Clearly the whole tax, the way the tax will look at this will be very different. The first question, will you get a deduction for the depreciation because you don't own that plant and equipment? Will you have to withhold tax when you make contractor payments to him, because then they are tooling charges and not really purchase of goods? Look at indirect tax implications. One of the bigger areas to my mind where a lot of positivity from a tax perspective will come when you move to Ind AS is when you look at business acquisitions. Now, today you have this whole issue of whether you get depreciation on goodwill when you acquire a business as a going concern. Most of the times it's not the accounting goodwill that is in question, but all the intangibles that you acquire as a part of it. Come Ind AS, the Ind AS will recognize all these intangibles separately in the books of accounts, and that will really help the tax claim on depreciation for intangibles. So there are some good things to look forward to, I think, on business acquisitions, and there will be obviously, but it's about knowing them, being aware, and getting ready for it.
And therefore being and preparing your contracts, etc.
Come Ind AS, there should be some standard then on MAT also.
And one more, I think, standard that's required is relating to post-balance sheet events and prior period items.
You mentioned when we were talking earlier on that, with the arrival of the Indian accounting standards, and you've identified some of the good and bad of this, but there will also be, the creation of several notional items that could, in a sense, lead to an additional tax levy of some sort or dispute on the tax fronts. You want to give us one or two more examples on that front to give a sense to companies of what they need to prepare for next year?
Just take a simple example of optionally convertible preference shares. Ind AS may treat that as a debt in the books. Now, the question will be the return that you pay to the investor, if there's a coupon that you pay on a year-on-year basis, that will be shown as before the tax item. So it's generally that before the above the line type of an item, and therefore the question will be, will the tax rules work as if it is dividends, or will the tax rules work as if it's interest? And it's quite different, as you know, with the treatment for both of them. To my mind, it's when we can sort of list down several such items, I think the answer really is that you talk about how do you prepare for it. I think a lot of homework needs to be done at the CBDT and the government and at a policy level, because this needs a policy response.
Clarifications I get, 2 sets of books I get. I want to know what else companies can do to prepare themselves. Will certain industries and sectors be hit harder than others?
It's going to be across the board.
Will your tax liability increase starting next year?
Certainly.
certainly.
Not
if
only-
not the absolute liability, definitely the litigation liability.
I'll say not only absolute liability, but this compliance cost is also increasing.
All right, on that note, I'm going to thank all three of you for joining me on this finale episode of Mind the Gap. I'd also like to thank Trilogy, the beautiful library in Raghuvanshi Mills at Lower Parel that has hosted this entire series and provided us with such a creative backdrop to very dense technical discussions. And thank you very much for watching.